Hello, very good morning to all and happy Friday. Welcome to today's Daily Dose of Market Insights. Happy Friday, good morning. I'm Kelvin here. Today will be the 11th of October 2024. So before we jump straight into our Daily Dose for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, it seems to me that there is some problem with the audio. Just do a sound check again. Is everything okay? Let me check my audio. Seems to be there is some problem with the audio. So is everything okay? Just give me a few seconds. I just will check my audio. Okay, just do a check. Give me a couple of at least a couple of seconds just to check my audio, make sure that everything is okay. All right, just do a check over here. Hope that things are okay so far before we could actually start the daily dose. Yeah, hopefully it's okay. Yeah, just to make sure that yeah, just to do a check over here. Yeah, it seems to me that just now I'm not sure what's going on. Okay, so basically, right, yeah, just where we are, yeah. Okay, so before we jump straight into, that usual short-term technical outlook on the broad-based cross asset classes, let's have a kind of a recap what has taken shape yesterday in terms of news flow and their impact on the various broad-based cross asset classes. So we know that yesterday's all-important news flow was the US CPI data. So but what's interesting is that I want to express the release of the data and how does it impact the various broad-based cross asset classes. Okay, so let me start with the data point first. Okay, so over here, the US CPI data, the core inflation. So market is more concerned about the core inflation rather than the inflation, because the inflation component consists of more volatile item like the energy and food. So if you look at the core inflation year on year, it came in slightly above market is expecting. So market is expecting at 3.2%. It came in at 3.3% on a year-on-year basis, and even the core inflation rate on a month-on-month basis came up above expectation as well. Market is expecting 0.2%, but it came in at 0.3%, almost in line. I would say in line, almost in line with what was printed in the previous month of August. Okay, 0.3, pardon me, 0.3. So then that overall, right, if you look at the year-on-year figure, after, because month-on-month tends to be very volatile. If you look at the year-on-year trend over here, okay, give me a minute. I think it's hang right now. Okay, I don't know what's going on. It's Friday. Everything seems to be pretty much slow right now. Okay, look, okay, so there was actually a uptick over here to 3.3%. So in terms of the market commentary over here is that market participants are pretty much worrying that inflation may start to run hot again, but that doesn't derail the US Federal Reserve from cutting rates next month and December. Why? Because if you look at the series of Federal Reserve officials speak after the release of this rather slightly hotter than expected year-on-year core inflation data, there are actually three officials struck off the CPI report. All right, and even New York Federal Reserve Williams says appropriate to continue moving rates on the downside. Only one part. There's another Federal Reserve officials banking still confident that inflation is coming down. Only one official boasting is open to a pause. Alright, so net overall, the Federal Reserve official, the Fed speak on Thursday after the release of this important CPI data, are more skewing towards cutting rates next month and even in potentially in December rather than having a pause. So that actually continues to see the US Fed funds rate futures expectation as being compiled by the CME Fed Watch 2 to still indicate at least a 25 basis point cut in the next upcoming month meeting on the 7th of November to bring down the Fed funds rate to 4.5% to 4.75%. Right now it's at 4.75%. Okay, so 4.5% to 4.75% imply a 25 basis point cut, and it has a high. Okay, let me please down lower. Okay, so it has a high chance of 86%. So what you could see over here is that almost the same because prior to the release of the non-farm payroll, prior to the release of the US CPI data, markets expecting 80% chance of a 25 basis point cut. And after yesterday's release of the CPI data, which came in slightly hotter than expected, but that pendulum actually increased by 6 percentage point to 86% chance of a 25 basis point cut. Okay, rather than having a high odds of standing pat by the US Federal Reserve. Okay, so only unchanged, small chance of only 14% that remains unchanged, and that remains unchanged, right? Actually, the percentage reduced prior one day before the release of the non-farm before the release of the US CPI data. It was hovering at 20% and it reduced down to 14% after that more or less a guidance from the US Federal Reserve officials public speeches that supports this ongoing interest rate cut cycle in the US. Okay, so if you go down the line, go down the calendar, that means going forward down the calendar, what we could see over here is that excuse me, we still see a series of 25 basis point cut in December and even in January next year. So how do we read this particular table very quickly? High chance of 84% to bring it down to 4.5%. Then thereafter on the 18th of December meeting, at 82% chance to bring it down to 4.25% to 4.5%. So that's an implied 25 basis point cut. Above 50% chance at 62% on the 29th of January 2025 meeting to bring it down to 4.0% to 4.25%, and another 25 basis point cut on the 19th of March to bring it down to 3.75% to 4%. So that's a chance of 55%. So net overall in the next I would say 3 to 4 meeting, there will be a potential higher odds of a series of 25 basis point cut each. But that jumbo cut of 50 basis point has been greatly reduced. Why? Because unless we start to see a very strong economic data, non-farm payroll, and later I'll share you one particular growth-related data that's out later in the US as well, that could actually lead to a resurgence of another 50 basis point cut coming into the market unless this set of data turns very weak. Later I'll share with you what is this data when we come towards the close of today's daily dose. Okay, so market now is actually now looking for only a series of 25 basis point cut. Then how does it impact in the various cross asset classes? So if you look at the FX market, surprisingly the FX market over here doesn't see a resurgence of dollar strength. In fact, dollar strength starts to be nowhere yesterday, and even previously the dollar strength was strongest against the Kiwi after the NRBNZ starts to be turned much more dovish and issue a rather dovish guidance as well. The dollar strength starts to temper off, and it also dragged down the dollar Aussie as well, also start to temper off. And against the European currency is almost nowhere, almost flat. And what surprisingly earlier on, we have started to see a very strong push out in the dollar yen at the start of this week, and even the dollar yen starts to plateau off as well over here. Then after that, we start to see the dollar Swiss franc also starts to actually plateau off in terms of the dollar against the Swiss. So net overall, what we could see, despite that strong, rather hotter than expected US core CPI print, slightly hotter, not very that hot, market the FX market didn't actually start to see a resurgence of dollar strength. And one of the reasons could be also related to technical factors as well on the 10-year and the 2-year US Treasury real yield. Nominal yield, not real, nominal yield. So what do I mean by that? If you look at the 2-year Treasury yield, okay, price action has a negative reaction right at the 4.12% over here yesterday. Okay, previously support resistance came down, hit up, form a bearish reaction at the 4.12% as well. That was a bearish reaction candle. And if you look at the 10-year US Treasury yield, okay, it also formed a bearish reversal candle, which is a bearish shooting star right at the 4.08% and 4.16% resistance level, which is also the 200-day moving average as well, this zone over here. So that actually also explained because of this bearish reaction of this respective key resistance level on the US 10-year Treasury yield and the US 2-year Treasury yield led to muted dollar strength yesterday. Okay, but however, what we could see over here is that the US stock market, okay, if you look at the US stock market, was rather muted. So there is no clear strength in the US stock market. It's rather muted. So the SPX, the Nasdaq, the Dow Jones, and the Russell 2000 all closed down, but they didn't actually see a pronounced sell-off. That means more like a pullback instead after prior Tuesday across the board strong rally and Wednesday strong rally as well. Wednesday, I would say Wednesday strong rally. So after Wednesday strong rally, Thursday we see a pullback in the major US stock indices. So it's more like a profit taking than a intraday sell-off instead. Okay, so it's more, if you look at the SPX movement, it's more like sideways. And interestingly, during the close of the US session, there was a slight uptick on the SPX index. So net overall is more like a pullback, similar to the Nasdaq as well. Managed to actually, okay, let me see. This is the Nasdaq 100. Okay, it managed to actually hold at this 20,200 level. There's a bounce over here. So overall, I could see is more like a pullback on the major US stock indices. The SPX down negative 0.2%, the Nasdaq down negative 0.13%, the Dow Jones down negative 0.14%, and the Russell 2000 down negative 0.55%. And also one of the reasons over here is it could be also geopolitical risk tension that also causing a bit of profit taking from these major US stock indices, considered as a risk on proxy as well, because there's this particular news flow coming out saying that there's this Iran secret warning to US airlines that not to help Israel, because right now there's this impending Israel retaliation towards Iran. And over here is that Israel has some option which particular target or assets that wants to which particular Iran assets they want to hit. So there is a risk that they may hit Iran's oil and gas producing facility or Iran nuclear producing facility. So net overall, that could actually increase this geopolitical risk premium over here. And right now, due to this secret warning towards US airlines, so Iran actually go through some diplomatic channel, and this US airline is actually the Arab states. That means we talk about potentially it could be Saudi Arabia over here, informing that they urging them not to actually allow their land to be used as US launch pad. Okay, launch pad when Israel wants to actually launch this attack on Iran. Okay, so net overall, we start to see this kind of geopolitical risk premium that is still intact in the Middle East, that also probably causes the US stock market to pull back as well. But what's interesting over here is that we see a resurgence in oil price. So oil price actually went up by 3% yesterday on the West Texas crude oil. So that also came in within our expectation. And what's interesting over here is that despite the hotter US CPI print, gold XAU/USD didn't actually fall. They actually rallied as well by 0.8% and managed to close above its 20-day moving average. So later we touch more about that from a technical perspective. Okay, so these are the key news flow and event that has taken shape yesterday and how they impact the various broad-based cross-asset classes. And right now, let me focus on one particular fundamental and intermarket dynamics that could have a longer time horizon to play out from a multi-week to multi-month perspective, which is primarily focusing on the gold market XAU/USD. So I do believe that this particular chart I do flash before in one of my daily dose of one of my daily dose is this US 10-year Treasury real yield at the top. This is considered as a long-term cost of holding gold. So we know that gold itself doesn't have any dividend. So if any long-term investor who bought gold, their only potential return will be the market price of gold, hoping for it to appreciate, okay, in the future. In between, then there is no dividend, no coupon payment of gold. So gold is like a competitive assets against bond. Okay, so the thing about bond return will be the yield. Okay, so if you look at the 10-year US Treasury yield, using this as a very, very international risk-free rate, because of the US being the biggest fixed income market as well in terms of the sovereign bond risk-free rate. So what we could see over here is that the 10-year US Treasury real yield actually managed to shape this bearish candlestick yesterday. There's this bearish harami candlestick. This is the daily chart right below this resistance level at 1.83%. And upon shaping that bearish harami candlestick, notice that the gold price also managed to stage a rebound right at this pullback area of this former major ascending channel resistance now turns into a pullback support level. Okay, this area here. So net telling us that this major uptrend of gold XAU/USD that is in place since the low of 5th October 2023 remains intact, supported by this bearish reversal candlestick, that is this bearish harami candlestick, taking into account of this long bullish candle. Then thereafter it starts to form a small little candle within the body of this long bullish candle. We call it a bearish harami, and the candlestick itself is also a shooting star if you look at a single candlestick. So we have a shooting star combination of two candlestick taking into account of this bearish harami candlestick right below a resistance level at 1.83%. This intermarket dynamics reinforce this ongoing major uptrend phase of gold XAU/USD that still remains intact. Okay, so net overall, whatever price pullback that we see on gold on the medium term of a intraday basis is more like a corrective pullback rather than a change in the major uptrend phase that remains still intact, supported by this US 10-year US Treasury yield that remains kept below this resistance level at 1.83%, and yesterday's price action on it potentially could start to see the start of another impulsive up move to resume a potential series of higher high. That means from here, this could be a inflection point where the next impulsive up move starts, and whatever this three-leg move here, 1, 2, 3, may have ended in terms of its corrective pullback phase, and this little push up over here on this former major ascending channel now turns into a pullback support, may kickstart a fresh impulsive up move that could have a higher odds to see a higher high. That means potentially new fresh all-time high in gold XAU/USD. Okay, so this is the fundamental and intermarket dynamics for today. I will share with you all pertaining to the gold market XAU/USD. All right, so with that, now let us now focus our attention to the focus our attention to the FX market instead. Okay, not the US major stock indices I will share later. Okay, so now FX market, so that will where we cover our intraday technical outlook. All right, so before that, let me expand my screen so that you guys have a better view on the chart. Okay, so let us start with the European currency first. Okay, so bear in mind, like I said earlier on, the trend of the FX dollar, the trend of the US dollar from a 5-day rolling performance basis over here. Where was it? Yeah, this point here, the dollar strength starts to plateau off, despite a very slightly hotter than US CPI print. So if we were to look at the euro dollar, so euro dollar yesterday did quite a messy move. So over here, yes, it broke down below our short-term pivotal support level at around the 1.094 level. Over here, 1.094, but it managed to come down close to the next support level at 1.089 before shaping a rebound during the rest of the US session. And it also came very close to the 200-day moving average as well. And what's interestingly over here, if you look at the daily time frame, okay, it starts to form a bullish dragonfly doji. Okay, and this bullish dragonfly doji from right at this dotted gray line here. So what's this dotted gray line? This dotted gray line is in fact the medium-term pullback support level. Now formerly it was a descending resistance break now turns into a pullback support that was previously in place since 19th of July last year. So it's quite a long time horizon. So I consider as a medium term descending pullback line, medium term pullback support line, and it formed right exactly at this 200-day moving average, pretty close to it, and it led to a bullish dragonfly doji after the end of that volatile movement yesterday, post risk event. Okay, so net overall, given this set of positive price action forming at a key support, medium-term key support level, we cannot be outright bearish despite it break below 0.940 short-term pivotal support level yesterday. So with that, I rather have, since it's Friday for today, I'd rather have a neutrality stance. So I flip to a neutrality stance, taking into account of yesterday's intraday high, which is at 0.950, that it can't break out after the release of the US CPI data release. And the lower limit of the neutrality range will be 0.890. So only an hourly close back above 0.950 later on today, then we will revive the short-term intraday bullish bias again on the euro dollar. Next near-term resistance level to watch will be at the 110 figure level on the euro dollar. Only a price action breakdown below 1.0890, then we could see a more pronounced corrective decline scenario unfolding in the euro dollar to expose the next near-term support level at 1.0845, followed by 1.0780 next. Okay, so this is the level here, the swing low area of 1st of August. Okay, so that's for the euro dollar. Turning our attention now will be the sterling dollar. So on the sterling dollar, let me share with you on the daily chart. So on the daily chart, yes, it's also formed this. It also formed this bullish dragonfly doji candlestick as well, right at the 1.30 figure level, medium term pivotal support level that we highlighted earlier. And given because of this daily bullish doji candlestick forming at a longer term time frame, 1.30 medium term pivotal support level, we cannot be outright bearish right now, despite the fact that yesterday there was a bearish reaction below the 130.70 short term pivotal support level. So what you could see over here is this okay, price action came down, it pushed back up again. So what we could do over here is, because since it actually went very close to the 130 medium term pivotal support level. So then overall, what I could have always, I'll be using 130 figure level 130 figure level as my medium term pivotal support for today on the sterling dollar. So what I could have over here is that I could still maintain that intraday bullish bias. Okay, because it came very close to the 130 medium term pivotal support level, because and it didn't break below it. So I cannot be outright bearish on the price action of the sterling dollar. And also given the fact that we start to see some form of bearish elements that has already resurfaced again on the 10-year US Treasury yield and the 2-year Treasury yield as well. So with that, I'll still maintain that intraday bullish bias on the sterling dollar. But however, price action got to surpass fast quickly at the 131.07 intermediate resistance level that we highlight today. So this is the level on Tuesday that it can't break, and also came very close to last Thursday push up as well at 130.90 before pushing back down. So price action now got to very quickly break above 131.07. Then we will see an increased odds of these bullish buyers resurfacing on the sterling dollar, with the next near-term resistance coming in at 131.60. Okay, 131.60. However, if price starts to break down below 130 figure level, then that medium-term uptrend on the sterling dollar will be in jeopardy, where price action could potentially see further weakness to expose the next near-term support level at 129.40, followed by 128.60 next, which is over this congestion area here, 29th of July and 13th of August. Okay, so that's for the sterling dollar. And what's surprising over here is that the turning our attention to the Aussie dollar, the Aussie dollar fared way much better than the European currency. So the Aussie dollar remains resilient over here after a retest of that 67.20 short-term pivotal support and traded back above the 50-day moving average as we are speaking right now. And what we could see over here is that the RSI continues to shape a higher low, a higher low. Okay, indicating that upside momentum still remains pretty much intact, at least on a short-term basis. So still no change. 67.20 short-term pivotal support on the Aussie dollar. Still maintain that intraday bullish bias. First near-term resistance level to watch 67.70. Breakout above it, exposure 68.10, which confluence with the 20-day moving average as well, I think as a similar resistance level. Only a breakdown below 67.20 will invalidate today's intraday bullish bias to see the extension of this corrective decline scenario sequence unfolding towards the next near-term support level at 66.70, followed by 66.35, which confluencing with the 200-day moving average as well. Okay, now turning our attention will be the dollar yen. So dollar yen continues to unfold as expected. So yesterday it did a retest again on the 49.30 medium term pivotal resistance level that we highlighted. Hourly RSI also now starts to actually break down from a parallel support level over here, now turns into a pullback resistance level right below the 50 level mark, 50 level, so indicating a lack of upside momentum at this juncture. So still no change. 49.30 will be indeed our key pivotal resistance level to watch out for today on the intraday basis after a test of it yesterday, right after the release of the US CPI data, but price action continued to inch down much lower. So as long as this 49.30 didn't surpass clearly on the upside, that means there's no hourly close above it for today. We will still maintain that intraday bearish bias on the dollar yen. Two key levels to watch on a short-term basis since really Friday, 48.13 or 48.13, followed by 47.20, unless we start to see a very clear breakdown during the European session or the US session at 147.20, then potentially we may see an extension of that down move to have a much more deeper drop on the intraday basis to expose the next near-term support level at 145.90 slash 145.45, 145.90, 145.45, which confluence with the 50-day moving average and the 20-day moving average as well. However, let's say if the price starts to break out above 149.90, then this bearish bias will be invalidated to see a continuation of this rebound towards the next resistance level, which is our major resistance level zone at 150.20, followed by 150.90, which confluence with the 200-day moving average as well. Okay, so that's for the dollar yen. Now, turning our attention now will be the major stock indices. Today, the Hang Seng Index will be closed. The Hong Kong stock market is closed for a holiday. So then bear in mind, do not forget, on Saturday, there's a key risk event coming up pertaining to the China stock market and the Hong Kong stock market, is where the China Ministry of Finance will announce the exact detail of that highly anticipated fiscal stimulus policy that the political bureau statement highlighted before the Golden Week holiday in China. So key levels still unchanged, still key levels. So yesterday it tried to break above the 21,550, can't break and start to trade sideways, but still holding above this medium-term pivotal support 19,790 slash 19,445, which is so correspond to the rising 20-day moving average. So these are the two key levels to watch out for as we the market is closed today. So it will also not open during the European session and the US session as well. So on coming Monday, these are the two key levels to watch out for. Okay, 21,550, 19,790 / 19,445. Okay, so that's for the Hong Kong 33. Okay, so now turning our attention will be the Nikkei 225 or the Japan 225. So like I mentioned, the Nikkei 225 continues to be a trap since the high of 27th of September. It continues to trade within this symmetrical triangle minor range resistance. So today there's a bearish reaction as we are speaking right now during the Asia session of the upper limit of this symmetrical triangle range configuration, which is our short-term pivotal resistance at 39,790. So still no change, still using 39,790 as the short-term pivotal resistance level. Still maintain that intraday bearish bias within this symmetrical triangle range resistance configuration. Support level to watch 38,740. Then followed by this one will be slightly higher. Okay, at 38,510 level, which is now the symmetrical triangle minor symmetrical triangle range support level. Okay, 38,510. Okay, this symmetrical triangle range support level. However, if price action starts to break out later at 39,790 with an hourly close above it, then this mean reversion pullback towards the lower limit of this symmetrical triangle range support level will be invalidated to kickstart a impulsive up move of the Japan 225, heading up towards the next resistance level in the short-term basis will be at 40,155/280, followed by 40,800/990, which correspond to the 0.618 Fibo extension taken from the low of 6th of September, and graphically this area here as well. Oops. Yeah, this congestion area here, 5th of July and 8th of July. Okay, so that's how I derive the 40,800/40,990. So that's for the Japan 225. Now, turning our attention will be the German 30. So the German 30, no change, price action managed to shape that pullback, and that pullback managed to help right above the 19,130 short-term pivotal support that we highlighted yesterday as well. So still no change, still this using this 19,130 short-term pivotal support to maintain our intraday bullish bias on the German 30. Next near-term resistance level to watch will be close to the all-time high area at 19,460/19,550. Only hourly close below 19,130 will invalidate today's intraday bullish bias to shape another round of corrective pullback scenario unfolding to retest the 8th of October minor swing low area and 4th of October minor swing low area, coming to act as a next near-term support level at 18,960. Only a breakdown below 18,960 will trigger a much more deeper corrective pullback towards 18,690 and even 18,510 level, which correspond to the rising 50-day moving average. So that's for the German 30. Now, turning our focus will be the major US stock indices, starting with the Dow Jones Industrial Average or the US Wall Street 30 with our platform. Price action reacted accordingly, where it managed to stage that pullback, and that pullback managed to actually also see a bounce off at this parallel support of the hourly RSI as well. So then overall, still no change. I don't put it so tight at 42,400 level, still using 42,180 as our short-term pivotal support level, which now correspond to this rising 20-day moving average as well. So as long as this minor pullback managed to hold at 42,180 short-term pivotal support, we'll still maintain that intraday bullish bias. First resistance level to watch will be the current all-time high area at 42,730. Above it exposes the next near-term resistance at 43,170. However, if price action starts to shape a hourly close below 42,180, then potentially we will start to see another round of choppy minor corrective decline sequence, retesting 41,950 again. A breakdown below 41,950 will trigger a much more deeper corrective pullback scenario to expose the next near-term support level at 41,535, which is the minor swing low area of 18th of September and 19th of September. Okay, now with that, let us now focus on the Nasdaq 100. So Nasdaq 100 also shaped that pullback, minor pullback, and it managed to stay a bounce off the first support level at 20,150. So I don't put it so tight at 20,150, still using 20,000 psychological level as my short-term pivotal support level. We also correspond very closely to this rising 20-day moving average. So 20,000 short-term pivotal support, and if minor pullback holds above this level, we will still maintain that intraday bullish bias on Nasdaq 100. looking for it to go above 20,360. Above it exposes 20,615 on a intraday basis. So this 20,615 is the minor swing high area of 15th of July. However, if price action starts to break down below 20,000, then we will start to see another round of choppy minor corrective sequence to revisit the swing low area of 2nd of August, 2nd of October, and 8th of October at 19,750 / 19,630. So that was a low form on last Friday after the release of the non-farm payroll data. Only a breakdown below 19,630 will see a much more deeper corrective pullback towards 19,380, which correspond to the rising 50-day moving average on the Nasdaq 100. Okay, so that sum up our intraday technical outlook on the major stock indices. So now let's turn our attention to the commodities market, starting with the all-important gold XAU / USD. So still recall that yesterday gold, we do have a bearish bias looking for a extension of that minor corrective pullback towards this 2,605, 2,590 level, and even 2,570. But price action managed to stage a bounce over here, and how it bounced over here is that it bounced pretty much a swift and steep because this bounce managed to actually close above the 20-day moving average, and we have a positive follow through right now in today's Asia session. So what you could see over here is that the means, i.e., that so-called extension of this minor corrective decline from 26th of December, looking for it to hit the 2,590 and 2,570 level. More or less, the odds has been very, very low right now due to the daily close of the price action yesterday at the 20-day moving average, and with a positive follow through in today's Asia session. So, and also like I shared with just now, the fundamental and intermarket dynamics, where the long-term 10-year US Treasury real yield has also managed to form a bearish candlestick right below a respective resistance level, right below a resistance level as well. So net overall, right, this price action of gold XAU / USD implies the resume or the continuation of the impulsive up move sequence within its medium term and major uptrend phase. So with that, we got to now flip to a bullish bias. That means we got to be very flexible. We flip to a bullish bias due to this ongoing positive price action that has been taken shape in gold. So with that, using 2,605, which is yesterday's minor swing low area, and 2,590 over here. Okay, this former range resistance, former swing high now turns into a pullback resistance. So as long as this 2,605 / 2,590 short-term pivotal support holds, we will still maintain our intraday. We will flip to an intraday bullish bias on gold XAU / USD. Now the RSI is coming close to is already in the overbought level. Perhaps we must start to see a bit of pullback, okay, to retest the 20-day moving average, acting as a first support at 2,627. Then thereafter, potentially the next resistance level to watch will be 2,657 on the intraday basis, followed by the current all-time high area, 2,674, 2,684 next on the intraday basis for today. If price action starts to turn choppy again and break down below 2,590, then this intraday bullish bias will be invalidated and kickstart the extension of this minor corrective decline towards 2,570, 2,548, which correspond to the rising 50-day moving average. Okay, now flipping on next will be the West Texas crude oil. So like I mentioned, the West Texas crude oil shaped a bullish bullish reaction, up by 3% yesterday. And if you look at the candlestick, this is a hammer, a bullish hammer right at the 50-day moving average and the 20-day moving average, acting as a support level at 73.15. And yesterday we have a very strong bullish candle follow through, so indicating that the oil price right now is still on the rise, potentially to revisit 78.30, then 80.30. 80.30 is very key. Why? Because 80.30 is this medium term in fact, it's not medium term, it's a major resistance, because it's already 1 year since the high of 28th of September 2023 that kept prices from rising previously. That 80.30, that is the key medium-term resistance level to watch out for. So on the daily basis, still remains unchanged. 73.15. I don't put it so tight. But first support level to watch out for will be at this 75 figure level. So 75 figure level first support, but 73.15 will still be my short-term pivotal support for today to maintain that intraday bullish bias on West Texas crude oil. 78.30, maximum 80.30 for now. However, if price action starts to break down below 73.15, then today's intraday bullish bias will be invalidated on West Texas crude oil to expose the next near-term support level at 71.50, 71.47, followed by 71.10 next. Okay, so that's for the West Texas oil. Now, before we go, let's take a look at the calendar. What are the key events and data to look out for today? So for today, what we could see over here is that during the European session, more pertaining to the sterling pound or the sterling dollar, at 2 p.m. Singapore time, you'll see the release of UK month-on-month GP data for the month of August. Then thereafter, during the US, before the start of the US session, for those who are interested on the Canada dollar, you'll see the release of Canada job data at 8:30 p.m., the unemployment rate and employment change. And more importantly, for US session, PPI not so important as compared to inflation. That will be out at 8:30 p.m. Singapore time, but the all important data will be more pertaining to the growth related economic data. In US will be the Michigan consumer sentiment data out at 10 p.m. Singapore time. And at 9:45 p.m. there's another Federal Reserve official speaking, Gooseby. That shouldn't be a changer because this official also speak a couple of days ago. Should be no change in terms of the tonality. And very important, on Sunday or Saturday, we will see the release of that detailed China fiscal stimulus measure going to be announced by the China Finance Minister Conference at 10 a.m. Singapore time on a Saturday. And also on Sunday at 9:30 a.m. we'll see the release of a bunch of key China economic data, inflation rate, PPI, and as well as the balance of trade, 9:30 a.m. and 11 a.m. on the Sunday. So very interestingly, we start to see a slew of key risk event and data taking shape over the weekend, this weekend, pertaining to China. So with that, that sum up today's Daily Dose of Market Insights. I'm Kelvin here. I wish you all a restful and a great weekend ahead, and we shall speak again on Monday. Thank you.